Hi there, my name's Chris Burrows. I've been in the mortgage business for about 15 years and have learned quite a bit about the do's and don'ts to credit, how to maximize your credit over time. And I wanted to just spend some time for you that have clicked on this video to kind of give you some ins and outs of what to look out for, some things you may know, some things you may not know, and what goes into a credit score and what you can do to help control that and maximize your borrowing power and what that can mean to you in dollars and cents, right? So we'll start off with just the basics. The credit report, it ranges, it's got a pretty good range. It's anywhere from a bottom of 300 to 850. And there's three bureaus that are managing your credit. You've got TransUnion, Experian, and Equifax. I'm sure you've heard of these agencies before, but they basically generate individual credit scores for you. So it's unlikely you're going to run a credit report for yourself and find that all three match because they have their own algorithms. And so you'll typically have three different scores normally. In the 15 years I've done this, I've probably seen them match once or twice. It rarely happens. So the lender that you're going to be working with will typically use what's called a tri-merge report, where they collect the credit report based off of all three of these bureaus. And they'll typically use the middle number, not the average of the three, but they're going to use the middle number to determine that credit score to be your qualifying credit. Okay. So there are some different factors. Obviously, they're going to contribute to your credit score. So I'm going to go over a few of them. Of course, late payments, right? We all know that late payments can have a negative impact to your credit report. So your willingness or even your ability to pay on time is going to affect your credit score positively or negatively. Late payments that you have, if you have that Visa account and you happen to go late, it's going to have an impact on your credit for about 7.5 years. Now, as time goes on, if you've had one event and never again, and time marches on, it's not going to take you long to get your credit score up relatively soon. And we'll talk about the timing of this in a little bit. Credit card balances that you are using based on the limit you're given is going to have an impact on your credit. I'll talk a little bit about that in a bit as well. Bankruptcies will stay on your credit report for 7 years. And foreclosures, once the bank takes your home, it's going to remain in your credit for 7 years as well. But the trick is that let's say you surrender your house in January of 2020 or 2021, and the bank finally sells it through a sheriff sale date in October of that same year. Well, the clock doesn't begin until the sheriff sale date. So it's a minimum of 7 years. It can even be longer than that if it takes a while for the bank to get it off their books and sell it through a sheriff sale date. Okay. A collection is typically an account that has gone delinquent. Could be a Visa card, MasterCard, that kind of thing. And then if you're not paying those bills, typically they can sell those debts off to collection agencies for pennies on the dollar. And then those collection agencies really, with a lot of fervor, go after people and call you constantly to try and get you to pay that collection back. Medical collections typically are not going to be a judgment on your credit report as far as a hit on your credit report, because you can't really be penalized for getting sick or getting ill. So, but it is advisable to get those removed because some lenders might look at them sideways and not want to do those loans. Judgments, like if you're sued or something, that can sometimes go on your credit report. Child support, alimony, that kind of stuff can affect credit. If you're not paying those debts back and going delinquent, that can have a factor on your credit report. Closing out accounts is eliminating valuable information that the credit's not being used. So if I have a Visa that's got a limit of $1,000 and I just close it, I've just let go of $1,000 worth of available credit on my credit report to be used. And again, the bureaus look at my available overall credit and how much I'm using of it and take that ratio to determine if you are managing your money wisely. And we're going to talk about that a little bit more in the coming slides as well. Now, opening a new account, that's always going to be a necessary thing we all need to do. Just be mindful that opening up a new account is going to result in an inquiry and a new account trade line. Every account you have in your credit report, like car loans and stuff like that, are called trade lines. So adding a new trade line kind of makes the credit bureaus a little anxious because you're looking to borrow more money. The inquiry itself is looking like you're wanting to borrow money. So the inquiry impact and the resulting opened account is going to have an initial impact on your credit report. Nothing to be afraid of at all. We'll talk more about inquiries in a bit, and what you should or shouldn't do and what your boundaries are, okay? Now, credit scores, I like to say they take the stairs up and the elevator down. So it could take many years to develop a high credit score, but if you miss a single payment, depending on what type of account you're being missed on, it could really make you lose a lot of ground and could take many years to recover the credit score after you've had an event like that, right? So whatever you can do, try and maintain a good payment history first and foremost, and be mindful of your limits and your cards, which we'll get into in just a moment. So there are a few common ways to establish credit from the beginning. So if you're younger and you want to get a credit score started, there are a few ways that you can go about it. Some of them have pluses and minuses. So let's talk about the most common one, is having mom and dad or a brother or someone co-sign for you. That is basically going to rely on that person's already established credit to basically vouch for you that if you don't make the payments, they will, and they'll go ahead and co-sign for you. And you can also be added as an authorized user. And what that means is basically if I have a Discover account and I want to just add you to my account as a user on the account, I can do that. And then all of a sudden, you're going to kind of piggyback onto my established credit that I've already created. Now, the downside is that if you or I happen to be late on one of the accounts, everyone that's tied to the account score is going to drop. So if you have mom and dad that's co-signing for you and you go late, that's the downside, right? You do put them at risk of having their good credit affected by your mismanagement of credit, right? The upside is it's easy to get started. If you've got somebody that is willing to co-sign for you, maybe that's not so easy, right? But if you can get somebody to co-sign for you, that's going to be the easier way to get going on it. So the other way that you can establish credit, which is probably the more preferred way that I'd recommend, is obtaining a secured credit card. And what that means is that you can go to Discover, for example, and give them, $500 that they hold on to. That's secured. And then they give you the credit card that has a limit of $500. So if you happen to go late on that credit card, there's no loss to the bank because they got the $500 you've given them. After a period of time, you've had the account for a year or so, you can always request to have the money released back to you. It's not theirs forever. I mean, if you close the account out, they owe you the money back, but you can always ask them to unsecure the card once you've established some good borrowing practices with them, okay? The downside, it takes some money up front to get started. So you got to have a little bit of money to secure on that card to begin with, okay? Upside, no one else's credit's placed at risk of you blowing it, going late on that credit report or credit card and affecting their credits. That's the upside. So credit card limits, let's talk about that for a minute as far as how that works, okay? That's the max that you're given to borrow against that card, okay? So let's use the example of a Chase credit card of $1,000 limit. That's the amount you're allowed to borrow again up to that limit, and you're obligated to pay that back. Now, for a tip on this, and this is one of the things that you may or may not know, the best practice is to maintain a balance of 30% or less of the limit you're given. So in this case, if you have a $1,000 limit, you want to maintain a balance that doesn't exceed $300. Now, I'm not saying maintain the balance, like keep it at $300 all the time, but try not to exceed that amount. That's the best practice. The fair practice would be maintaining a balance of 50% of the limit. In this case, it would be $500, right? Simple math. So in this case, we wouldn't want to exceed the $500 balance. That's your fair practice. It's not going to get you into the middle to upper, 700s or 800s score, best practice is going to get you there. Worst practice, never exceed your limit, even if you do it once. So if you think of back on computer games, right? Get a high score in a computer game. Credit bureaus utilize the same type of thinking, right? They want to keep track of your high score. So if you've taken a balance to 1,001, even exceeding the limit, it'll have a record of that forever, saying, hey, John used 1,001 of his $1,000 limit. And that's another thing that does take time to recover over time. But this is what's called overutilization of your available credit. And it does negatively affect your credit score pretty good. So one thing you can do is you can ask the debtor to double your limit. Maybe you call Chase up and say, hey, Chase, would you mind giving me a limit of 2,000? Now they'll look at your credit report, they'll run your credit, put an inquiry on there. They'll ask you some questions about your income, and they'll get back to you in about a week with the answer as far as what your limit's been raised to, okay? So by increasing the limit to $2,000, you're artificially putting the borrower at a 50%. You're putting yourself at that 50% limit of your balance to limit ratio. Sorry. So that's one way you can artificially get below that 50% mark, is just by doubling the limit if they're willing to do that. Okay. So things to keep in mind when you're establishing your credit score is avoid closing accounts. I kind of touched on that earlier. By closing accounts, it eliminates that available credit you had to begin with, that had like a buffer in your credit report. Unused credit you have available demonstrates a responsible and reasonable utilization of your credit limit to the bureaus. So if you've got credit on there, you're not anxious or in a hurry to spend, the bureaus look at that as a positive, and that can help your score. Closing your accounts, you lose all of that history and the available limit along with it. Don't open up accounts unnecessarily. For example, you go to Best Buy, right? And you want to buy that TV, and they offer you the credit card. You want to make sure you look over these terms carefully. You may opt to go ahead and get that Best Buy card. You may be trying to get some extra trade lines, because if you got 3 or 4 or 5 trade lines, it's kind of where you want to be. So if you buy the TV at Best Buy and they offer that credit card, just be careful, because they might give you a limit of $1,000 for that $800 purchase. Boom, you're past 50%. You've got an inquiry. You've got a new account. You got an account that's past 50% utilization. That's a trifecta of death. I mean, that's the worst thing you can do. So if you're going to get that TV for $800, look for a $2,000-$3,000 limit. You know, don't put yourself in an immediate situation where you bought that TV and it cost you dearly on your credit scores. Okay. Newly opened accounts have a temporary hit to your score, of course, but it's recovered over time as you use your credit responsibly with that debtor. Now, when you apply for credit, you have an inquiry, and people are always afraid of inquiries. You know, one of the hardest things to get a person to do is to run their credit. It's a stigma. Everyone's kind of globbed onto it, and everyone's heard in the grapevine, don't run your credit. Let me give you some things to think about on that. So now, when you're running an inquiry for a credit card, it's a separate hit to your score. So if you run your credit with Best Buy to get a credit card from them, and then you go to Home Depot the next day, now you've got 2 hard hits and possibly 2 new accounts. It's going to really kind of rock your world on your credit report for a period of time. So those are kind of, you've heard of the term maybe hard inquiry or hard hit. That's what we're talking about, is that kind of thing. Now, when it comes to buying a home, refinancing your home, car loans, the bureaus give you a window of 45 days to run your credit as much as you'd like, and it counts as 1 inquiry, and the inquiry is only going to hit you for a few points. I'm always amazed at, and I can talk to you guys pretty openly, right? You're not talking to me, asking me for a loan, so I'll just kind of talk to you about what happens behind the curtain. But when somebody says, oh, I don't want to run my credit, why? Why? This is why we have a credit report, is for such a purpose as this, to run the credit. It doesn't hurt to check it, gives you an opportunity to shop around, and run it as much as you want. It counts as one inquiry. And the effects of that inquiry drop off after 90 days. Now, the inquiry itself will be a record on there still, but the effect to your score is recouped in 3 months. It's sometimes odd to come across a person, they've been late on their car loan, they've been late on their credit cards, they got some mortgage lates, they got collections. Oh, but don't run my credit. I don't want my credit score to drop. Well, where were you when you had these credit issues, right? Yes, life events happen, right? But don't be afraid to run your credit, especially with the ability to shop around and find somebody you want to work with, okay? So just be mindful of that. It's not taboo to run the credit. It may be a bit taboo to go chasing after all those credit cards, but if you're being responsible about it and being mindful of your limits and being mindful of what they're giving you, it's worth the hit up front for the benefits on the back end. Okay, less soapbox, I know, guys. Okay, so there are some things you want to avoid when you're developing your credit score. Again, collections, not including medical. Get those collections taken care of because you're holding your credit score hostage until you pay them back. So take care of your collections. Late payments, obvious, right? Be careful of that. Now, as far as what is a late, if I have a credit card that is due on the 1st, but is considered late on the 15th, if I pay it on the 16th, yeah, I might have to pay a late fee, which is something we all want to avoid. We don't want to pay more money than we need to in life, but it doesn't count as a 30-day late that hits your credit report. It's just like a slap on the wrist. You didn't pay us by the 15th, give us our money plus 20 bucks, right? No big deal. Now, if you make your June payment in July, that's a 30-day late. You've gone a full 30 days without making your payment, and that's an event that's going to hit your credit report. So be mindful of that. Make your payments due in the month that they're due. Pay any late fees you may need to, but don't go a month late. That's what it's called, a 30-day late payment. Okay. Overutilization of your credit limit. We already talked about that on the 30 and 50% limits. Make sure you don't max out those cards or use too much of them. That's going to allow yourself plenty of available credit as a pad, as a cushion in your credit report. Bankruptcies, of course, and foreclosures hurt. Short sales. Again, you sell your house for 130 and you owe 150, and you ask the bank, would you take 130 because it's not worth 150 and I can't pay you back? The bank might say yes, but here's the caveat you want to be careful of. On a short sale, if they say, hey, you owe us 150, we'll go ahead and forgive the 20,000. What they're going to do at that point is they're going to send you a 1099, which is like a W-2, of $20,000 that you earned as income. And at the end of the year, you get to pay old Uncle Sam 30% or whatever the amount is that you've been forgiven in taxes due. So that could be $6,000, $7,000, $8,000 that's due at the end of the year for the 20,000 you've been forgiven. So be mindful of that. Okay. And utilities can also have an impact. If you don't pay your cell bill, they can go ahead and make a report to the bureaus and mark you delinquent as well. Now, disputes is a thing where if I don't agree with something that Visa is doing to me and they say I've been late, I dispute it. No, I wasn't late. I paid you on time. That trade line goes into dispute. And what that does is it puts your credit score on hold for a bit. So once that dispute is resolved, your credit score can either bounce up if you were right and they back down and say you're right and then they remove the late, or if you are late and the dispute's resolved in their favor, your score will take a hit. So many lenders don't want to lend you any money if you've got disputed accounts because they don't know what the end game is on your credit score. They may need a minimum credit score of 620 and you're at 625 right now with a dispute. If you lift the dispute and you agree with the debtor, your score can go down to 619. You're out of the game. Now you can't do anything. So don't use disputes to try and improve your credit score. Utilize that as necessary if it's a true dispute. I've seen people trying to dispute all kinds of things to try and put themselves into the dark side of the moon of not being able to be seen by lenders. It doesn't work. So don't fall for that. Just be sure you're only disputing things that are truly have merit. Okay. Now the government, the old government, right? You cannot go bankrupt on the government. So be sure that when you borrow money from the federal government, you have a plan to pay them back. It's going to stay on your credit report forever until you pay it back on any federal debt. That includes student loans. If you get a student loan, great. Go to Sallie Mae, get your student loan, have a plan to pay it back. Don't let it go delinquent to where you can't get out of underneath it. State and federal income taxes you owe. Death and taxes, right? We have to pay them. So be mindful of that. Now, what's the big deal of a lower score? I mean, really, what's this all about? What does this mean? So let me give you a couple scenarios. Here. We got Bob, right? Bob wants a mortgage, and so does Charlie. They actually want to live next to each other. And they both want identical homes. Okay, so let me give you the specifics of what the loans look like. Okay, so Bob, he's got a score of 640, below average, okay? Now, Charlie has a good score, not great, but he's got a 720 score, okay? Just 80 points apart. So both of them are looking to get a loan in California for $400,000, if you can find a house in California right now for $400,000. Now, I used my pricing screen to come up with identical scenarios for these two guys based solely on their credit score. All other things are equal in this comparison. So Bob is going to get an interest rate of 4.625%. Not great, not bad. And a side note, little sidebar, I always find it comical that I have someone that has a really poor credit score and they want that 1% interest rate. It's just like, it's not gonna happen. You're going to get the credit you deserve, good or bad, right? It's just the way it goes. You create layered risk when you come to a lender. They look at everything. They look at your income and everything else along with it, and then they based on the risk involved, determine what you're going to get approved for, right? So Bob, not great, 4.625%. His payments $2,047 for the next 30 years. So if you kind of do the math, he's going to spend a little over $720,000 in payments. So the bank's going to get $320,000 in interest over the life of that loan. Okay, don't be shocked. That's debt. Okay, that's just how it works. So Charlie, he's going to get 3.375%, quite a bit better in rate, and his payments $1,768 a month. Okay, over that 30-year period. So he's going to be spending $636,480 in total payments over that amount of time. Quite a difference, right? It's $104,040 more than Charlie will be paying over the life of the loan is what Bob's going to be stuck with, right? So let's have a little fun. Okay, let's talk about what can you buy for $104,040. Well, first of all, you can buy a pair of his and hers Model Y long-range Teslas. Yes, you can buy two of them just because of your credit score of what you're going in to get your debt. You're gonna be able to afford to buy two of these babies. Okay. You like iPads? How about one for every day of the year? Practically 347 iPads you can buy with that money saved. Again, just by the nature of having good credit, you can afford to buy all your family members and friends an iPad. Like fishing? How about two fishing boats? One for the weekdays, one for the weekends, right? That's something you guys can purchase with that saved money. Hungry? How about 26,000 Big Macs? Okay. I can't say any more about this one because I'm getting hungry and my mouth is watering. So 26,000 Big Macs. How about 111 Xbox Series X consoles? Just because you had better score, you paid less interest to the bank over the amount of time. 37 top of the line TVs. You can buy those as well. Ronald Reagan would love this one. You can buy 8,115,120 jelly beans with that amount of money you've been saving. So that's something you can keep in the back of your mind, that if you can borrow money for lower interest, you're going to save interest on the back end for all those jelly beans. Okay. So now, if you're in a position where your credit score has taken that elevator down, here's some principles of things you can kind of do to help nurture this back up. Obtain a credit card. Like we were talking about before, maybe get a secured card. Use it for only your needed expenses with your limits in mind, that 30% threshold, and pay it off each and every month. Because you may try and get another credit card and debtors might tell you no because your scores are poor. No one's going to say no to a secured credit card. Excuse me. Pay those credit cards down to 50 or 30% of the available limit. We'll talk a little bit more about that in a minute again. And then once those are all down to 50 or 30%, then methodically make your way through them by paying them off one by one, okay? Request, again, to have your limits doubled if they'll allow you to do that, something to explore. If you're capped in the limit and you request the limit to be doubled, that artificially puts you at 50% of the given limit. Keep in mind that not all creditors are going to agree to that, except they might agree to your secured card. Now, if you are at your limits, request another type of card such as Best Buy and start to utilize this strategically by using it again conservatively and paying it off each month. Now, once you have a handle on paying your debts down and they're at all at that 30% limit, now we want to focus on paying them off. So here's some principles to keep in mind. Sort out your bills based on the interest rates from the highest to the lowest on your kitchen table, regardless on if it's a mortgage or a car loan or any other kind of debt, interest rate. And then focus on paying that down. Any extra money you have, apply that extra money you have toward the highest interest rate debts first. And then as each debt's paid off, take that payment you were making on that credit card and snowball it into the next credit card, and so on, or debt, whatever that interest rate debt is from the highest to lowest. You're going to pay those down one at a time. Again, not closing out the accounts. Now, with the exception of a retirement account, leave your 401ks alone. Don't go anywhere near them, okay? But don't hold on to, I put here large balances. I would even venture to say don't hold any balance in a savings account while you're dealing with paying off your debt. And it says here, yep, you heard me correctly. So let's take a look at that and I'll this will make sense here in a minute. So here's the scenario, okay? You got $5,000 in savings, earning 1% interest if you're lucky, okay? Now, you have a credit card that has a balance of $5,000 at an interest rate of 18%, okay? In this case, you are losing 17% per month in money. Every month, you're losing 17% of your money, okay? If you pay off the credit card with your savings, you're earning 0, but you're also not losing 17%. So you're kind of like making money in a way, right? But not losing it. If you ever have a life event where you need that cash that was in savings, go back to the credit card if you need it and do a cash advance or something and pull the money back out again. That's why it's important to keep using your credit cards that are 0 balance every once in a while so that the debtors keep them open, because a stagnant credit card can end up getting closed by the creditor, okay? Now, different scenario approach on this would be you've got that $5,000 in savings, earning about 12% interest, lucky you, and you have a credit card that has a balance and an interest rate of 7%. So in this case, any extra cash you have at the end of the month needs to go into your savings account, earning that 12% interest, okay? You're basically borrowing money for cheap and using that money to generate additional interest income, right? So as long as you know what your earnings capacity is versus what you're putting out every month in interest, you'll be able to leverage, do I go to pay my extra money toward my credit card bills or toward my savings account? So be mindful of what you're earning and what you're paying, okay? So here's some debts to maximize and create a good future as well. Pay off your credit cards every month. Avoid paying those finance charges. You know, it's just money ill spent. Never pay the minimum payment. Here we see a balance of $575.23. The debtor's only asking for $25. Oh, how gracious of them, right? Well, the problem is that as you use your available credit, And if you make your minimum payment and your balance increases over time, so does your minimum payment. I've unfortunately worked with a lot of clients that have had such tremendous debt, and it's gotten away from them, that they're in financial bondage. Your minimum payment can reach such a limit to where that's all you're able to afford to pay every month. You can't even touch it. And I've seen people get in bondage under this kind of mindset for decades. They can pay off their house sooner than they can pay off their Visa card in many cases because they just cannot get caught up. Okay. Now, I'm not just saying this because I'm in the mortgage business, but you want to protect your mortgage above all. Okay. It is the anchor to your credit report, to your debt. If you need to go late on something, if you have a life event where you have to miss something, don't let it be your mortgage. You don't want to lose your home that's above your head. Now, I've had many times where over the 15 years I've been doing this, I'll have a borrower that has a late on their visa, they got a car payment, maybe they got a collection that's been in collections for a year. I'll give them a mortgage, no problem. Whereas if I have somebody that has a mortgage late payment, I can't. FHA, for example, you can't have a late payment in the last 6 months. You can have one in the last year, but nothing in the last 6 months. So if you're looking for something to get out of debt and you've had a late payment recently, you're not going to, don't even ask. It's not going to happen. The federal government's going to say no to you, right? So the mortgage is going to be that piece you want to protect as best you can. Now, if you ever do need to get some money out, people do cash out refinancing all the time to get their equity out to maybe put in a pool or whatever. If you have 27 years left, for example, consider taking a 25-year term when you get your cash out. That's going to actually thrust you forward and paying off the house even sooner, and you don't have to worry about restarting the clock. Now, if you can't afford to go forward a bit in time, go ahead and take your 30-year term. And as you can afford to make extra payments and it's, reasonable for you to do based on your other credit to pay money down toward the mortgage, you can do that and pay it off in a short amount of time. But try to launch yourself forward rather than setting yourself back in time. Okay. Again, we talked about not closing out your accounts. We want to leave those intact and utilizing your credit carefully. We all need toothpaste, right? So we want to use that revolving account to purchase our needed items and pay off the card at the end of the month as long as we're mindful of that limit. That's going to develop healthy utilization of your credit and healthy gums. I know that's kind of corny, but keep that in mind as well. Avoid buying something in hopes you're going to have enough money to pay the bill at the end of the month. That's credit failure 101. You want to try and budget your expenses properly and living within your means if you can to maintain that good credit profile. Okay. So that's all I have at this point. I hope that it helps you a bit. If you have any questions, go ahead and hit me up in the comments section below. I'd be happy to answer any questions for you. But meantime, Godspeed on your credit ventures, and hope to see you on your fishing boat soon. Take care.